These tariffs, and I mean the market's initial reaction rather confirms this, these tariffs are basically driving the global economy into recession, slump, depression, I don't know what we'll call it. And the consequences of that, of course, are that tax revenues will disappoint, welfare costs will be higher than anticipated, government finances will take this very, very badly at a time when government finances are actually in a debt trap. Everybody is assuming that interest rates will go down. The Fed will lower interest rates because they have to, and they're going to have to rescue the economy. So, it's the Keynesian playbook, but it's complete rubbish.
Silver just endured its worst weekly drop since 2020, sinking more than 13% as markets struggled with growing recession worries, widespread liquidations, and weakening industrial demand. The sharp decline highlights the increasing macroeconomic strain, with President Trump's aggressive trade stance playing a major role in altering the demand picture for silver. His sweeping tariffs, particularly those aimed at China, sparked a reevaluation of global trade flows and manufacturing prospects. The levies targeting semiconductors hit silver especially hard, given its extensive use in tech and industry. China's countermeasure, a 34% tariff on all U.S. imports, has only intensified fears of a prolonged and disruptive trade war. As a result, demand projections have plummeted, especially in key industrial hubs like Asia and Europe. A brutal sell-off in equities, marked by a 2,000-plus point nosedive in Dow futures, triggered margin calls that spilled across asset classes.
Is a hell of a lot of investment. Now, they're not going to hang around while a bear market rages and just sort of sit on their position. No, they're going to sell it down. They're going to panic out. They're bound to. And are they going to go and buy US treasuries and corporate debt? The risk-free alternative? No, as far as they're concerned, that's not the risk-free alternative. The risk-free alternative is to get into cash in their own currency because they're running balance sheets in their own currency. If they're going to see no risk at all or minimal risk, it's got to be back into their own currency. It doesn't matter how bad the currency is. That is where the buying is going to go. And we've seen this reflected already in the dollars trade weighted, which, you look at the chart of that, it's awful. That's the only description I can give it. It fell 2% yesterday. It's like more than 2%. It's steadier today. But, there's no doubt, looking at the chart, that's going to go below 100. It's currently 102. Going to go below 100, and it's going to be on its way to 90. And, we see what happens then. Allegedly, Trump wants to see the dollar lower. He's going to get his wish. But this is very, very bad news because how does the foreigner then get enticed back into the dollar? The answer is you've got to offer him an interest rate to entice him back into the dollar. You then look at the consequence of interest rates on the debt trap. And oh dear, this gets worse and worse and worse. In other words, we're getting into this sort of maelstrom, if you like, whereby everything's going round and round and round and disappearing into the black hole of nothingness. That is basically what's happening. And it's happening to the value of credit. You cannot reduce the amount of credit outstanding without banks or businesses going bust. That is the way outstanding credit gets reduced. If it's not going to get reduced that way, then it gets reduced in its value. So what will happen is that the Fed will be pushed into interest rate policies which basically destroy the dollar. And we're just in the early stages of this. And as for the commodities, this reaction actually is completely wrong. But it's understandable, being the first, if you like, the initial shock. And bear in mind also that there's still quite a bit of leverage in the US equities. If you look at the FINRA numbers, I think in February it was a short $1 trillion of debt, leverage in the market. That's getting caned, absolutely caned. So you can see that this is not good. It really is not. And first reaction to hit everything, including commodities. I think that the swaps, if you like, in gold and silver and in other commodities, the other futures commodities, are understandably trying to close down their positions. So they bash these prices, they bash them down. And of course, nobody wants to challenge them at the moment. They will manage to close some of their positions at a lower price. I don't think they will in gold. There might be some, but I mean, gold is interesting because on COMEX, there's less than 500,000 contracts outstanding, which is not an overbought situation, if you like. You don't have all these hedge funds long of gold, short of dollar. No, they're not at all. So the amount of stuff that's going to get shaken out on the bull tack, I think, is going to be disappointing as far as the swaps are concerned. Different position, obviously, in silver, because you haven't got central banks buying silver, which effectively is the backstop on gold. And on that basis, this is why silver has fallen by 6%, 6.95%. I see on my chart today, having had another very big fall yesterday. So that, I think, roughly is where we are, Jesse. It's interesting times. I see this in two phases. I see the initial shock, and then I see people looking at things a little more rationally, and then looking at the opportunities. And to my mind, the opportunities are quite simple, because it's the dollar going down, buy commodities, buy precious metals. But it's going to take, if you like, things to settle down a little bit before people seriously consider that.
Silver bore the brunt as investors liquidated positions to raise cash, while gold, despite also being sold off, was partially shielded by its safe haven appeal. Silver's challenges were made worse by a strengthening U.S. dollar and rising real yields. Bond markets found some stability following upbeat jobs numbers, pushing the 10-year yield back toward 3.88%. As traders pared back bets on aggressive Fed rate cuts, the dollar rallied, adding more pressure to silver prices. Now, attention shifts to upcoming Fed minutes and Thursday's CPI report, which could significantly sway market expectations. If the Fed signals reluctance to cut, or if inflation surprises to the upside, silver could face more downside amid tighter financial conditions. On the gold front, prices also fell sharply as panic swept through global markets, but the underlying outlook remains strong. Stocks plunged again at the start of the week, driven by volatility in the Asian markets following China's retaliatory tariff announcement and escalation of last week's Liberation Day trade shock. Hopes that tensions might ease were quickly dashed, with investors increasingly bracing for a U.S.-led global slowdown. The result was a wave of selling across nearly every asset class. Even gold, traditionally a go-to during crises, wasn't spared. XAU/USD has fallen over 6% since Thursday. But this sell-off appears more technical than fundamental, likely driven by forced liquidation. With losses piling up elsewhere, investors turned to liquid assets like gold to meet margin calls. Still, the longer-term picture for gold remains positive. With markets on edge, central banks treading carefully, and uncertainty at elevated levels, gold's appeal as a safe store of value continues to stand out. Last week, Fed Chair Jerome Powell reiterated a cautious approach, reinforcing the central bank's weight and stance in light of mounting volatility. This week's March CPI data will be key. A softer print could revive the case for rate cuts and spark renewed gold buying, while a hotter-than-expected number might force the Fed to hold off on easing, injecting more instability into the outlook.
At this stage is quite simple, and that is it's sell equities, buy bonds. But bonds are actually the wrong thing to buy. I mean, particularly where you've got duration. Don't buy duration, for goodness sake. So that's what the regulators tell investment managers to do. And anyone who passes a CTA exam knows that, the way risk works in a portfolio is the balance between equities and bonds. Commodities are never mentioned. It's just not part of the whole scene. And indeed, Physical commodities are not regulated investments anyway. So, the establishment, and we're really talking about the investment establishment educated by governments and by their regulators and all the rest of it, has a very, very clear and simple response under these circumstances. And what this means is that where you got losses, basically you sell anything else in order to cover those losses. And that's what we're seeing in markets. And of course, the shorts in futures are, making hay out of it. I mean, they really are. That's why we got 7% falls today after 5% falls yesterday. But what we saw at the time of the Great Financial Crisis, I think we see again. At the time of the Great Financial Crisis, we saw gold get knocked from about $1,000. It got up to something like 1,050 or something. It got knocked from there down to about 680, and that was more, sort of more spread out than this current episode. It took, I don't know, 3-4 months for that to happen. But once that was over, gold then went on up to 1920 in late 2011. Because you had the knock-on effects, if you like, of the Great Financial Crisis. Particularly, you had, sort of, if you like, European debt problems and all the rest of it. Various crises in Europe, which sort of rolled and rolled and rolled. And of course, everybody wanted to get out of credit and get into safety, which was really what happened. This time, I think the situation is actually far, far more dangerous. We might see the authorities trying to steady the equity market. That wouldn't surprise me at all. But look, what we're seeing is the largest credit bubble in history going pop. And it's going pop in exactly the same way as a lesser credit bubble in 1929 went pop, with combination of that and tariffs. Smoot-Hawley Mark II, I'm calling it. I think that rather like in 2000 and late 2008, the initial shock takes out everything, and then people sort of think, hold on a minute, gold is actually where we should be, not in credit, as it were. And I think we're already getting, this is not something else. This time, we got central banks doing it. Central banks are buying gold. Why? They're actually selling credit. They're getting out of paper currencies, they're getting out of fiat currencies. It's a big, big message which we've got to hoist on board. That is the difference between 2008 and today. And of course, they don't buy silver, which is why silver goes down. They don't buy copper, which is why copper's going down. And they don't buy oil, which is why oil and energy is sinking. But that will turn round, because over long periods of time, the purchasing power of gold is very steady when it comes to buying these commodities. So, all this is pretty temporary stuff. I'm not giving a steer in terms of timing. All I will say is that the downside in gold, I think, is extremely limited, simply because central banks are standing there just picking up any loose stock they can possibly pick up. So that's going to keep things tight in gold. We have a real crisis in the markets, and that is going to lead collapsing equity values. And I wouldn't be surprised if this crash continues next week, like big time. That sort of thing begins to affect the banks, because the banks have this stuff as collateral, equities as collateral. And not only that, I mentioned the leverage, around about $1 trillion of leverage. It's less than that now. I should think it's probably around about 850 to 900 billion. But on top of that, you got the commercial real estate problems and all the rest of it. I wouldn't be surprised if the next thing we see in a few weeks' time is a number of banks, if you like, being questioned about their survivability. The other thing, which is something that hasn't happened yet, is the collapse in crypto. That's going to happen. You've only got to look at how Bitcoin correlates with NASDAQ. I mean, it's the same, or particularly the Magnificent Seven. It's the same cohort who are long of Bitcoin, who are long of those Magnificent Seven tech stocks. Watch that Bitcoin. I don't make investment recommendations, but I would not be surprised to see that as one of the best shorts at this stage in the market. So we're talking about the enthusiasm, if you like, that you get in the top of a credit bubble. It's that's evaporating. And the consequences are on values the whole way across the board.
That was Alasdair Macleod's take on where gold is headed and how the BRICC nations are pushing toward a gold-backed financial alternative. Do you think their strategy could upend the global system, or are the hurdles just too steep? Share your thoughts in the comments. Don't forget to like and subscribe, and check out the next video. It's a perfect follow-up to this one. See you there.